Welcome to Investing Outside the Box. I'm David Harris with Alternative Investment Advisors. And after more than 30 years advising high-net-worth individuals and institutions, I've learned one thing. True opportunities often live beyond the traditional stock and bond markets. This show is designed to give you insight into alternative investments, private equity, real estate, hedge funds, and other strategies that don't always make the headlines but can play a powerful role in building and protecting wealth. Each week, we'll explore unique opportunities, interview thought leaders, and challenge conventional thinking so you can make smarter, more informed decisions with your capital. Let's get started.
Welcome to episode 2 of Investing Outside the Box, where we challenge the status quo of traditional investing and shine a spotlight on smarter strategies for building and preserving wealth. I'm David Harris, registered investment advisor and principal of Alternative Investment Advisors. With over 35 years in the financial trenches, today I'm going to reveal 4 powerful tax-saving strategies that most investors, and frankly, many advisors, don't even know exist. If you've ever thought, there's got to be a better way to reduce my tax bill while building wealth, this episode is for you. Let's dive in.
Alternative investments like private credit, more available to retail investors than ever before. It's a revolution really is taking place in finance. And Robert Frank is joining us right now to talk about the launch of CNBC's new Inside Alts newsletter, which gets into all of this. And the revolution is here now.
Yeah, Andrew, revolution is a really great way to put it, because from private equity and private credit to venture capital and hedge funds, the world of alternative investment is going mainstream. Total assets under management for alts has more than doubled over the past decade, from $7 trillion to $18 trillion today, expected to top $29 trillion by 2029.
Here's the truth. High income and high net worth individuals are often penalized in the current tax system. Traditional portfolios don't do much to mitigate that. That's where alternative investments come in, not just as a diversification tool, but as a powerful tax strategy. At Alternative Investment Advisors, our entire focus is on vetted alternative investment opportunities. We're fiduciaries. We don't sell commissionable products. Everything we offer has been thoroughly researched, independently reviewed, and selected with our clients' best interest at the center.
Stay quiet until you hear the best investment ever. Bitcoin, stocks, gold, real estate, the S&P 500, yourself.
That one's priceless.
Let's start with a high-impact strategy using real estate and a Roth IRA conversion. Cedar Street, a private real estate sponsor, offers a multifamily investment that's especially attractive when combined with a Roth IRA conversion. Here's the magic. Suppose you convert $250,000 from a traditional IRA to a Roth IRA. You'd normally owe income tax on that amount. But Cedar Street's fund offers accelerated depreciation, generating significant passive losses in year 1. You may be able to offset up to 40% of the tax due on the conversion. And there's more. The investment itself is a 3 to 5 year hold. And once the money is inside your Roth IRA, all future gains from that point forward are tax-free. This is a powerful double-barreled strategy. Reduce today's taxes while creating a future stream of tax-free income. It's ideal for clients nearing retirement or those looking to convert before tax rates potentially rise in 2026.
All right, you're here still with Sam and Alex, and this week's episode is about the $250K flip. I just want to say, dude, every time I look at my tax bill, I feel like the IRS is my business partner.
That one got me. That's because you're only playing with traditional investments. Ever heard of flipping $250,000 into a Roth with real estate?
Okay, sounds painful already. Huge taxes, right?
Normally, yes. But here's the twist. With a Cedar Street multifamily investment, you get accelerated depreciation. That can knock out up to 40% of that tax bill.
Hold up. So I pay less tax today, and once it's in the Roth, all future gains are tax-free?
Bingo! Reduce the hit now and lock in tax-free growth for later.
Wow, finally, a way to outsmart Uncle Sam without breaking the rules.
Next up is a Qualified Opportunity Zone QOZ fund offered by Cantor Fitzgerald. This strategy is designed for investors with capital gains from real estate, stocks, a business sale, you name it. Here's how it works. You roll your gains into the Opportunity Zone Fund. You get a deferral on paying taxes until the end of 2026. And if you hold the investment for at least 10 years, you pay zero tax on the growth inside the fund. Think about that. Defer taxes now and eliminate them later. Cantor's fund is focused on multifamily and industrial projects in growth markets, backed by a firm with decades of institutional credibility. For high-income investors, it's a compelling blend of tax strategy and real asset exposure.
All right, opportunity zones. Sounds fancy, right? But here's the deal. If you just sold real estate, stocks, or maybe your crypto bag before it tanked, Uncle Sam is lurking, ready to take his cut. Instead, you roll those gains into an Opportunity Zone Fund. What's that? Basically, the government saying, hey, invest in this area we actually care about, and we'll let you keep more of your money, at least for a while. Translation, you help rebuild communities, you delay taxes, and potentially reduce them later. So yeah, instead of giving it all to the IRS, you get to play real-life Monopoly with better tax perks.
Let's talk about one of the most underutilized but incredibly effective tax shelters, direct oil and gas investing. RGP Oil and Gas offers a direct participation program with very high first-year deductions. Here's the kicker. Up to 90 to 100% of your investment may be deductible in year one. These deductions apply to ordinary income, not just passive income. Plus, you still get ongoing cash flow and potential upside from production. It's one of the few ways left in the tax code to offset W-2 income or business income, especially for high earners. Oil prices may fluctuate, but the tax savings are real and immediate.
Alternative investments is this really broad term, and it encompasses everything from venture capital, blockchain, all the way through to alternative investments backed by real property. The space that I play in is alternative real estate investments only. And the reason I like that space is because they have less subject to volatility, they have more predictable returns, they are a very private shop, and they operate in very inefficient markets, which means there's more opportunity.
Last but not least, let's talk about infrastructure, an often overlooked category that offers both stability and tax benefits. Cantor Fitzgerald's Infrastructure Fund gives investors access to large-scale projects like data centers, transportation, and utilities, but through a tax-efficient structure. Here's what makes it stand out. Income is often structured in a way that includes return of capital, helping reduce taxable income. The fund provides steady, predictable yield with lower correlation to traditional stocks and bonds. And it's backed by a global firm with deep experience in capital markets and infrastructure financing. For income-focused investors, this is an elegant way to generate reliable cash flow while keeping taxes under control. The fund currently offers a 4.00% annualized distribution rate based on the most recent quarter's payout and average daily net asset value, or NAV. Since its inception, the fund's average distribution rate is approximately 4.98%, though notably, 83% of those distributions are categorized as return of capital for tax purposes rather than income.
What is the best investment of the past 100 years?
Gold.
Gold is number 8, 0.7%. Do you love number 9? Diamonds. Diamonds is number 9.
Bond.
Global bonds is at number 5, 2%.
Real estate.
Real estate.
Real estate's number 10, 0.3%.
To invest in oneself. Okay.
Spain probably has more of this than other countries.
Debt.
I'd say Italy has a lot of it, actually.
Pasta.
Like, okay, what do you have with pasta?
Tomato.
Not tomatoes.
Oh, wine.
Wine,
yeah. My girlfriend works in wine sector.
Wine is number 2.
Oh, maybe art?
Yes, art is number 6.
Okay.
Like maybe an instrument.
Yes.
Trumpet?
No.
Saxophone?
No.
Guitar?
No.
Piano?
No.
Violin?
Yes. 2.4%.
Nice.
Crypto and equities, is that what you're looking for?
Number 1 is stocks with 5.2%.
Sure.
It's a collectible item. They're the third best investment of the past 100 years. Postage stamps.
And that's an investment?
Yeah.
Every strategy I've talked about today has one thing in common. They're not mainstream, but they're vetted, legitimate, and optimized for high net worth investors. At Alternative Investment Advisors, we're not here to sell. We're here to solve with strategies that are independently researched, third-party verified, and customized to your goals. If you're tired of the same old financial advice and ready to discover what's really possible with your wealth, let's talk. Visit us at www.altsadvisors.com or email me directly at david@altsadvisors.com. If this episode gave you a fresh way to think about tax strategy, I'd love for you to subscribe, share it with a friend, and leave a comment down below. But more importantly, go to www.altsadvisors.com and schedule an appointment to learn more about these investment strategies and how they might fit your unique situation. Next episode, we'll be talking about how to evaluate real estate deals, what to watch for, and how to stress test them like a pro. Let's get proactive about your tax plan and put alternative investments to work for you. Until next time, keep thinking differently, challenge the norms that hold most investors back, and keep investing outside the box.